Hey guys, it's Kyrill Asatur, and this is the Centerfin Collective Weekly for the week ending May 31st, 2024. As always, we like to highlight a handful of things in markets and investing in business that happened this week that we thought were interesting. This week, we'll discuss some observations about the software industry that came on the back of earnings from Salesforce. We also wanted to do a little bit of a refresher and an update on the housing market, which we've talked about in the past. As it pertains to the software industry, so this week, Salesforce, which is a big software company that primarily deals with CRM software, which is client relationship management software used for marketing and sales, reported earnings. And for the first time in 20 years, they missed both on the top line and the bottom line. Very uncommon for the company. It's known as a fast grower, very well operated company. And the stock was down at some point 20% on the back of that earnings miss. They still reported growth in revenue for the first quarter. They reported almost 11% growth, but they guided to only 7% for the second quarter, which is the slowest earnings growth, revenue growth that they've ever guided to. And the market was really spooked by that. They cited a number of things, but when you read through the comments from the CEO, it seems to be that there's two things going on, one of which is cyclical, and the other potentially is secular. And so the cyclical thing that might be happening is that as companies are cutting back in potential preparation for a slowing economy, they're laying off people, and hence they need less licenses. And so the contracts that are being signed are for less people. The way that software contracts work on the enterprise side is that they sign long-term contracts with a certain amount of licenses corresponding to the number of people that will be using the software. And so as companies are laying people off, they might need less licenses. And some of what we're seeing is potentially coming from that. The other thing that's related to that is that as companies have been investing a lot of capital in their generative AI strategy, that might come at the cost of a budget for external software providers. So those are cyclical things. So those things could be just temporary. But the more important thing and the secular thing that we wanted to highlight is potentially more concerning, which is the fact that a lot of this generative AI technology that companies are building right now can be used to replace the software that they previously used. In 2011, Mark Andreessen famously said software is eating the world, and he was very prescient. Software as a service, as a business model, has been a very dominant business model for the last decade and a half, because oftentimes companies will use software instead of building it themselves. They will buy software from a company like Salesforce. Generative AI has changed that dynamic where a lot of the functionality that software is used for at large companies can be actually built fairly easily and replicated and potentially replaced internally. And so if that trend continues to be the case, that's going to put pressure on businesses whose primary business is software as a service, like a Salesforce, like Adobe, and many others. As an example of that, there is a big company called Klarna out of Europe, which is a private company that's preparing to go public. They're a big BNPL company, which is a buy now, pay later company. And they actually reported some stats this week. And one of the things that was glaring was that they said that they were able to, in the first quarter, take out about $10 million of annual costs out of their marketing and sales budgets by using generative AI. And so that, if you just think that through, that is a hit to software they potentially were spending money on that they don't need to spend money on anymore. We think this is something to pay attention to. We're in really early days of adoption of generative AI technology, but it is going to affect a lot of these software companies. And these software companies historically have traded at very significant valuations because they're fast growers and they have great margins. But if generative AI could be used to replace a lot of the functionality that they provided, that may change. And so it's something we're paying attention to, and we thought it was important to highlight. The second thing we wanted to discuss is a refresher on the housing market and an update as to what we think was going on there. So the housing market is near and dear to most people's hearts because everybody needs a home, and your choice is to either rent your home or to buy your home. We'll stick to home ownership for the purposes of this update. It's difficult to make broad generalizations because real estate in general is a very location-specific type of market. But real estate is an asset. When you own your home, it is an asset. And assets are interest rate sensitive. And when interest rates are low, that makes the values of assets go up. When interest rates are high, the values of assets should generally go down. And real estate, particularly homes, have been somewhat immune to the recent interest rate rise And it's been a little bit confusing to most folks and most observers that pay attention to this. Real estate values, home values across the country have stayed at historically high levels. They're at all-time highs. As interest rates have gone from zero during the pandemic and very low pre-pandemic to 5.5%, as we know, and mortgage rates have gone higher. I mean, so lots of folks have been scratching their heads about why that is. And what that's done is that it's made housing affordability, your ability to buy a home, trade at its lowest level in over 20 years. The housing affordability comes from the fact that most people buy a home, not based on the value of the home, but based on the monthly payment, which is comprised largely of the principal and interest for that home. And so as that interest portion, as mortgage rates have gone from less than 3% during the pandemic to close to 7% today, that interest portion of the mortgage of your monthly payment has gone up significantly. So that's made the home less affordable. And so affordability is at 20-year lows. And naturally, you would think that housing values should decline. And like we said before, they have not declined. And two things need to happen for affordability to go up, right? So interest rates need to come down or housing values need to come down. Neither has happened. Interest rates are really controlled by the Fed. And the Fed has told the market they're in the kind of higher for longer regime. So that's not happening anytime soon. And housing values have not come down because there is a supply demand element to housing values. And so as homeowners that are sitting in existing homes and are looking to potentially sell them have been holding out because they are waiting for those interest rates to come down for people to be able to buy the home at that higher value, that's taken supply off the market. So the recent supply report was that there's only 4 months of existing home supply on the market, which is very low relative to history, which is what has kept prices high. Now, what we saw this week that may be a turning point for the housing market is that pending home sales, so this is where contracts have been signed, but the deal is not done yet, were down 7.7% in April from the prior month. That's usually a leading indicator of existing home sales. We're watching that to see if the number of homes that are being bought and sold is going to decline into what is a generally hot season, the summertime, for home sales. The other statistic that we saw this week was that Redfin reported that the percentage of homes with a price cut rose to 6.4% in the week ending in last week. And this is the highest level in a few years. So we may be at a turning point finally for housing prices. It's TBD. Like I said, we're entering a strong part of the season for home sales. But if we see housing prices come down, that could have ramifications down the line because homes are generally where most people's wealth is tied up. And so if those values come down, that's going to have a negative effect. So that's all we had today. As always, let us know if there's anything you would like to discuss in more detail. And if there's anything you'd like for us to discuss next week, please feel free to comment. Have a great weekend.